Coca-Cola just posted a massive 58% jump in profit this quarter. And no, that's not a typo. Meanwhile, over at GM, it was a rough ride. Here's your quick and clear breakdown of both earnings, Coca-Cola and General Motors, July 22nd edition. Let's start with GM. And honestly, things don't look great. The company pulled in $47.1 billion in revenue, which is down about 1.8% from last year. It's not a total collapse, but the deeper you look, the worse it gets. Adjusted earnings per share came in at $2.53, down 17%. And adjusted EBIT, a key profitability metric, plunged 31% to just over $3 billion. But the real kicker? Free cash flow from the automotive segment, money left over after all expenses, was down nearly 47%. That's a big red flag, especially for investors tracking GM's ability to fund EV expansion and dividends. So, what's causing the slide? According to GM, they got slammed by $1.1 billion in tariffs this quarter alone. Throw in higher warranty costs, stiffer competition in the EV space, and shrinking margins, and it starts to make sense. Even GM Financial, which usually cushions the blow, saw its net income fall from $610 million to $510 million. Now here's the twist. Despite all this, GM is standing by its full-year forecast. They're still projecting between $8.25 and $10 in adjusted EPS, with $10 to $12.5 billion in EBIT and up to $10 billion in free cash flow by year's end. So either this was their worst quarter, or they're betting big on a strong rebound. Now let's talk about Coca-Cola. And this one's a lot more refreshing. The company posted $12.5 billion in revenue, up just 1% on paper, but the real story is in organic growth, which hit plus 5%, much better than expected. But here's the headline everyone's talking about. GAAP EPS surged 58% year over year, landing at 88 cents per share. That's a monster jump, especially for a giant like Coca-Cola. Even their adjusted EPS, and which smooths out some noise, now it climbed a solid 4% to 87 cents. So what's behind the growth? A big part of it came from price increases and a favorable mix, up 6%. Translation: people are buying more premium beverages, and Coke is charging more for them. Meanwhile, Coca-Cola Zero Sugar continues to crush it, posting double-digit growth globally. That's been a key driver quarter after quarter. Now, volumes were down 1% overall, but the strength in pricing and brand loyalty more than made up for it. As for the outlook, Coca-Cola isn't changing course. They reaffirm full-year guidance with 5 to 6% organic revenue growth, a 3% increase in EPS, and expect to generate about $9.5 billion in free cash flow this year. We'll have to see how Wall Street digests all this. With GM's profits and cash flow dropping that sharply, pressure on the stock is almost inevitable. Meanwhile, Coca-Cola might get rewarded for its earnings beat and strong outlook, especially with that 58% profit spike. GM is clearly struggling. Lower sales, shrinking profits, and tariffs slicing deep into cash flow, but they're not backing down from their full-year targets. Coca-Cola, on the other hand, is flexing with strong brand power, pricing strategy, and solid financial control. 58% profit growth doesn't happen by accident. That's your TLDR earnings update for July 22nd, GM and Coca-Cola.